Imagine your money had an expiration date, or if it could only be spent on government-approved items. This isn't some distant scenario. It's already being tested. In China, digital currency trails have set spending deadlines, making money vanish if not used in time. Central banking digital currencies aren't just about convenience. They give authorities the ability to monitor, restrict, or even freeze your funds at the source. Unlike cash, these digital tokens can be programmed and controlled with a few lines of code. More than 120 jurisdictions are exploring or piloting digital currencies. Behind the promise of modern payments is a system where your financial autonomy could disappear overnight. Before we get into the future, let's look at the illusion of privacy in the money you use today. You swipe your card, tap your phone, transfer funds. It feels private. It isn't. Every digital transaction leaves a payment trail. Banks do more than process payments. They monitor, record, and report. Under the Banking Secrecy Act, financial institutions must flag suspicious activity. That could mean anything from a sudden large withdrawal to a series of small deposits. That's more than 26 million reports in a single year, roughly 1 for every 12 adults in the US. The Patriot Act broadened mandatory bank reporting and gag orders without customer notification. Your bank isn't just serving you anymore, it answers to them. The third-party doctrine means you lose constitutional protections the moment your money enters a financial institution. They watch deposits. They analyze spending patterns. They flag anything outside your so-called normal behavior. This surveillance is not manual, it's automated, driven by algorithms that profile and evaluate your financial life in the background. Here's how it plays out. Try breaking up a large deposit into smaller amounts to avoid attention? That's called structuring. And it's a red flag. The system is built to catch anything that looks like you're trying to hide. Even the IRS buys commercial transaction data to cross-reference tax returns. Your financial life isn't private. It's an open book, maintained under the guise of security. The system is sprawling. Pawn shops, car dealers, jewelers, all deputized to collect and share information. So what once targeted major criminals now sweeps up ordinary people. In 2022, the cost for banks to comply with these rules was nearly $46 billion. The government's access is vast, millions of records, often without warrant. Between 2019 and 2022, ICE collected about 6 million financial records, focusing on transactions over $500 or from Mexico, all without judicial oversight. But even with this surveillance apparatus, banks still act as intermediaries, a buffer that CBDCs will eliminate. A new kind of financial connection is taking shape. One that links you straight to the state's core ledger. The European Central Bank's digital euro isn't just a technical upgrade, it's a shift in power. The ECB's intermediated distribution model puts commercial banks and payment providers in charge of user interfaces. But the central bank itself controls the master ledger. Every digital euro unit is issued and settled under central authority. No more fragmented records. No more waiting for compliance teams to review requests. The entire transaction history updates in real time, visible to the institution that designed the rules. Traditional banking keeps layers between you and the state. Local branches, compliance departments, and legal procedures slow down access to your financial footprint. CBDCs flatten that structure. The ECB's two-tier system means private firms distribute the digital euro. But the core record keeping, who owns what, who paid whom, runs through the central bank's infrastructure. There's no procedural hurdle. No buffer of delay. The state's eyes are on every transaction as it happens. In 2019, Fed Chair Jerome Powell told Congress that central bank digital currencies force a trade-off. We would be looking at trade-offs between privacy and illicit activity. That's not an abstract concern. The Bank of England's own discussion paper on CBDCs states that a single authoritative record of all transactions is a requirement. One central database, one set of rules. Full visibility. The Boston Fed's Project Hamilton demonstrated a single ledger handling over 1 million transactions per second. The tech is ready. The only barrier left is policy. Cash withdrawals, transfers between banks, small purchases in person. These are the shadows where privacy lives. CBDCs erase them. The Bank for International Settlements calls it unified ledger technology. One system, one record, everywhere. All the time. The central bank isn't just the issuer, it becomes the final authority on every payment. Privacy features in these systems are narrow by design. The EBC's prototype offers anonymity vouchers for small payments, a limited temporary shield that can be revoked. Sweden's e-krona requires identity checks for every user. These aren't oversights, they're features. Programmability, traceability, and compliance are built into the architecture. The direct line to your wallet isn't just about speed or efficiency, it's about access, instant, total, and irrevocable. But the real transformation isn't just about who can see your money, it's about what your money is allowed to do. Programmable compliance isn't a theory, it's already operational. China's digital yuan pilots made this clear. In one trial, digital wallets loaded with government-issued funds were locked to specific cities. Shenzhen residents received e-yuan, and they couldn't spend it in Shanghai. The money itself refused the transaction. Geofencing enforced by code, not by policy. The currency tracked location, obeyed boundaries, and denied any attempt to cross them. Time limits add another layer. In Shenzhen's trial, e-yuan vouchers expired in a week, pushing 90% of participants to spend them, according to official reports. The incentive wasn't a sale or a coupon, it was the threat of digital disappearance. The expiration date wasn't a suggestion, it was a command. This is not a bank's decision or a merchant's policy. The control is embedded in the money itself. The Bank of International Settlements called this absolute control on the rules and regulations that determine how digital currency can be used. Every transaction carries invisible instructions. The central bank becomes the rulemaker and the enforcer. The code checks who you pay, where you pay, and what you buy. China's system already blocks payments based on merchant category codes. Attempt to purchase something outside the approval list, and the transaction fails instantly. No appeals, no manual review. The decision is automated, final, and silent. The International Monetary Fund's 2024 working paper on CBDCs outlines the logic. Programmable money can be precisely targeted for specific users. Relief funds coded for groceries, not entertainment. Subsidies restricted to rent, not travel. The digital currency enforces policy at the point of sale. The code doesn't just record your choices, it shapes them. During lockdown, digital yuan wallets in Chengdu worked only within safe zones. Step outside the boundary and your wallet goes dark. The technology infrastructure already ties together transport, utilities, and welfare. Financial compliance merges with behavioral compliance. This is more than efficiency. Programmable money turns economic policy into direct control over daily life. Expiration dates, spending limits, and location restrictions become levers for shaping behavior. The architecture is built for compliance by design, not by accident. What happens when every rule, every restriction, every approved purchase is recorded, enforced, and archived? The boundaries of compliance blur into the boundaries of surveillance. The German Informatics Society uses a term that's hard to ignore. Gläserner Mensch, the transparent human. Not just observed, but exposed. Every cup of coffee, every rent payment, every grocery run, mapped, cataloged, stored. With CBDCs, this isn't a future scenario. It's a system where real-time financial profiling becomes standard, not the exception. Cash leaves no trace. Credit cards show fragments. A central bank ledger gives a complete, unbroken record. Every transaction, every location, every pattern. China's social credit system already ties financial behavior to privileges. CBDCs would enable real-time adjustments to your spending based on similar algorithms. The Human Rights Foundation documents cases where dissidents have their accounts frozen. No judge, no warning, just a silent digital lockout. With CBDCs, those freezes become instant and absolute, enforced by code, not by court order. Europe's central bankers acknowledge the trade-off. Christine Lagarde admits full anonymity won't exist with the digital euro. The solution? Anonymity vouchers. Temporary, limited, and revocable. Privacy isn't a right. It's a feature you request, and the system can retract. Every transaction is logged, geotagged, analyzed. Germany's warnings aren't theoretical. They've watched surveillance expand from tax compliance to social control, each new justification erasing another layer of informational self-determination. Nigeria's e-Naira rollout shows how quickly the logic spreads. Welfare payments linked to digital wallets, villages forced to adopt the system to access food. Then, during health emergencies, authorities block transactions for the unvaccinated. Money becomes a compliance tool, turned on or off by policy, not by need. The Bahamas Sand Dollar launch shows how islands are adopting to CBDCs for welfare distribution, illustrating rapid global spread. The HRF CBDC trackers reveals a pattern: convenience, then mandates, then control. Sweden's e-Krona pilot requires full identity verification for every minor transaction. Barbados integrates digital currency with tax authorities. Once the infrastructure exists, new conditions are just software updates away. Transparency isn't just about what you spend, it's about sorting, scoring, and controlling. Employers could demand transaction histories. Insurers could mine your spending for risk. Dating apps could filter matches by financial habits. The German Informatics Society warns, informational self-determination collapses when money becomes a live feed of your private life. In closed societies, the consequences are immediate. Belarus uses financial data to track protest organizers. The system doesn't just watch, it acts. Surveillance always starts with volunteers, early adopters trading privacy for convenience. But the infrastructure doesn't forget, and once the system is in place, The power to control access to your money is only one command away. There's a new kind of risk built into programmable money, a risk that isn't theoretical. The real innovation behind CBDCs isn't just surveillance, it's the off switch. Cash can't be disabled. Bank accounts require legal process. But digital currency by design can be frozen or erased with a single command. The European Central Bank's own research spells it out. Privacy is no longer a baseline, it's a feature, granted or revoked by authorities. Their anonymity vouchers proposed in the ECB's proof of concept act as temporary privacy passes for small transactions, issued by an AML authority, limited in scope and always subject to removal. Privacy is rationed, not guaranteed. Sweden's e-krona pilot follows a similar path. Every transaction is tied to an identity. Data is shared with authorities and intermediates on a need-to-know basis, a phrase that means the system, not the user, defines what's private. The architecture is built for instant compliance. Traditional banking has friction, manual reviews, procedural delays, human oversight. CBDCs remove those barriers. The ECB's Eurochain project demonstrates how a central bank or designated authority can freeze wallets at the ledger level. No paperwork, no warning. Countries have shown willingness to freeze digital funds during unrest, a power CBDCs would automate and expand. Distributed ledger doesn't mean decentralized control. Sweden's Riksbank designed its system to provide selective transparency, sharing information with regulators and intermediaries as required. The Bundesverband der Deutschen Industry warns, programmable restrictions, money that expires, only works in specific locations, or shuts off after a set date, are not hypothetical. China's digital yuan already enforces these rules. The technology exists. The only variable left is policy. The ECB claims the digital euro will balance privacy with anti-money laundering needs, but their own technical paper reveals the trade-off. An ALM authority issues the anonymity vouchers, so privacy is always provisional. Larger transactions are flagged. Surveillance is default. Privacy is the exception, and it's an exception controlled by the state. Cash makes anonymity automatic. CBDCs invert that logic. Now oversight is built in, and freedom is conditional. Cybersecurity is another threat. A centralized ledger becomes a single point of failure. The Bank for International Settlements warns, critical infrastructure risks multiply when all value flows through one system. Hackers could drain wallets. Governments could impose sweeping freezes in emergencies. Temporary controls have a way of becoming permanent. The proposed digital euro includes per-user holding caps as a stability feature, which also contains personal autonomy. Too much value in digital form threatens the banking system, so limits are coded in. The logic is simple. Keep most of the money where it can be monitored and managed. CBDCs don't just monitor transactions. They embed the power to restrict, freeze, or erase value instantly, silently, and by design. The off switch is not a side effect, it's the main feature. And as more central banks move from theory to development, the question shifts. Not if the switch will be used, but how far its reach will extend. By March 2024, 134 central banks were evaluating or piloting CBDCs, representing 98% of world GDP. This is not a gradual rollout. It's an unprecedented shift in monetary infrastructure. The technical capacity is already in place. China's trials demonstrate how control works. ECB documents confirm surveillance is built in. The IMF advocates programmable restrictions. All of this moves quietly, labeled as modernization, while dismantling financial autonomy. Nigeria ties welfare to digital wallets. Sweden removes the option for anonymous transactions. Canada's emergency asset freezes preview what CBDC kill switches could look like. Temporary measures become permanent. Convenience becomes compliance. If you value financial privacy, share this video and join the conversation in the comments below. Understanding these systems is the first step in pushing back before programmable money takes hold.